Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, active, passive in the industry, this is the YouTube show and podcast designed especially for you, breaking down all the latest research reports, data, articles, and throwing out some original opinions from the Gray Capital team. I'm joined by Dr. Matt Bosnagel, Director of Communications and Marketing. My name is Spencer Gray. I'm the president of Gray Capital. Fascinating reports. We got a print from on the CPI from the Bureau of Labor Statistics, as well as a report from John Burns Research and Consulting, really going into this whole idea of student debt relief being canceled and how is that going to affect the economy and renters going forward. I mean, it's a major issue. Just think about all of the renters that have student loans that they need to pay because they took out the loans. We're also talking about a piece from Fannie Mae, consumer confidence in housing may have plateaued. Let's see if that's the case. And from RealPage, apartment demand rebounds as rent growth further cools. Again, if you are at all in the space of real estate investing, you stick around, like, subscribe. Let's get into it. Welcome back to the Gray Report. Thanks for joining us. Matt Bosnagel, co-host, making it all happen.
Yeah.
Producer, reporter, everything. Matt, good week?
Yeah, this week was pretty easy. I knew the CPI was coming in. I was like, I'm going to put that in there. And then I just saw some articles just flowed right in. And so it's really interesting. That student loan article is particularly interesting. And I just think I've been thinking a lot, and what the articles that came across this week and some of our discussions is like, what is how to forward project things. We were talking yesterday about what is it, the factors that make a market on the upswing or on the downswing.
Yeah.
And I think that the same thing is true for the market in general, and things like inflation and this student loan as a factor, the jobs market. We're getting a lot of information, and we're getting some information about like apartment demand and how that relates to rent growth as kind of a leading indicator.
Yeah.
A few leading indicators that came across this month, and some of them are positive. Some of them is like, let's wait a little bit longer, but no doom yet.
No, I think it's a great point of, what are those leading indicators? Give us a little bit of an idea of what, demand's going to look like. It's not going to provide all the answers because we don't know everything. We don't know all the data points, and things change, daily, weekly. I mean, we talk about it all the time, and we're on a 3-week cycle of going from hard landing, soft landing, recession, no recession. And that's okay. We'll never know. And that's what makes it interesting. But to make some really well-informed decisions, understanding just the direction of where the wind's blowing, I think is important.
And there's a lot more physics. I feel like when it's coming to a lot more easy to project when you're talking about market fundamentals and the fundamentals of the apartment market rather than the investment environment, which seems like it's just a little more dicey, a little more unpredictable.
Absolutely. Because you look at the stock market that's, pricing in, it's a discounting mechanism. So it's pricing in, future events that may or may not happen and get right and get wrong. But then you look at, if we're looking at rents, especially CPI, in rents themselves, you're looking at a rent, growth report. It's inherently lagging because the data is up, a month old. But then you look at CPI, which we're going to just jump into here in a second. Sure. The way that they calculate it, it's a very much a lagging indicator, 12 months of lag. And so, if you don't know those nuances, you could make some wrong conclusions.
Yeah.
So, but let's look at, man, again, this is lagging also. Let's look at the new CPI report put out by the Bureau of Labor and Statistics. Now, this is for the month of June. But it looks like basically, the headline here is year over year, top line inflation has grown by 3%.
Yeah, that's great. That's insane. The fall off of more than 1% from last month, the year over year. Now we're including everything in the year. It's not a monthly thing, but it is.
And it's compounding. It's compounding off of, a lot of growth. So it's not like prices have gone down, but, the rate of growth has gone to a much more normal level. And this is still with shelter rising, albeit not at a fast rate, but shelter inflation is really buoying the rest of the CPI print, which isn't surprising to us because, again, there's that lagging indicator. And if we understand that, we can look back to the data that we have over the last 12 months. And you and I were talking about before the show, it's really that drop off really didn't take place until like September. So this isn't really surprising, but 3%, Matt, 3%. That the target's 2.
I know, but 3% seems so low already.
I know it does. And, this is, and why all this matters is, the Federal Reserve at the last FOMC meeting said, we're going to pause, but there's probably going to be 2 more 25 basis point rate hikes.
Yeah, so, and I remember, we heard that. It's like, well, let's see what happens.
To
CPI. And when you see this, I don't think that he's going to do one next month.
No,
or they seem wants to get that shock in. But if you look at this really, and we'll see in the following article from the Federal Reserve Bank of New York, they're looking at inflation persistence, and it looks like we're headed in the negative. If you factor in how rents are calculated, that swings us pretty much to the negative.
Yeah.
And it's like.
So it shouldn't be surprising. Yeah. So you heard from Matt here. So we think it's going to be on the October release of September. When do you think? Not to put you on the spot, but we're looking. Let's.
It's going to take way too long.
What's your call?
Frustratingly long. By September, we may be instead of having 8% year over year rent of primary shelter inflation, we'll probably have like 6 or 5, which is still pretty high.
Do you think that by September it'll still be that elevator? Do you think it's going to come down? Do we have to wait until like December and January for it to really bottom out?
I think so. Yeah. Because the CPI rents, they don't swing as quickly and as a rent, like the rent growth that we see from market rents. And it's a very smooth curve. But if you look at it in relative terms, the incline in rents was enormous.
Okay, so this is from this apartment list data, but it also overlays CPI, rent of primary residence, and just the top line inflation. And so this, we can kind of see what happens. So, let's just look, it also has, historicals from the last couple of years, starting in 2018. You can see, again, back in 22, let's say, I don't think it's exactly 12 months, but CPI, shelter, it's about a 12-month lag indicator.
Yep.
Let's just say that. So, we're going back we're looking at June of 2022, and, this isn't interactive. I can't give you the exact number, but I mean, we were coming off the crest. We were starting, that's why it's, and that's so it makes sense. So in today's CPI report, it's like, oh, it's cool, but it's still growing. It's just the rate of growth has started to cool, but we don't come down this slope really till later in the year. And it's not until, it really gets, into next year where it starts actually, going, there's a couple of months that were negative. Going down to the month over month, we can see that really, again, it's September until we get to that month over month negative rent growth. And it really doesn't get down to negative 1% until November and then December. So we really are going to have to wait. Later in the year.
Yeah,
what do you think, man?
I don't think that CPI is going to ever dip to the negative because so many things are kind of smoothing out the sharpness of that. But I do think that, we've got some time.
On the shelter, you don't think it's going to... And I think...
Yeah, on rent of shelter, I don't think it'll go straight up negative. It may go negative on the month-over-month basis, but when you're talking about year-over-year, I'm not sure if it'll ever dip. But it could. I just think there's so many things that smooth out the extremes that you see when you're comparing to.
I think that's a good point. You're probably right, but it's not surprising that shelter's still up.
Yeah.
But we could imagine that it will be, a fraction of what it is in the next coming months.
We could have 9 months and really until it's back to like maybe 3.5 or 5.
Yeah.
It could normal be, range.
Yeah. It could be that long. Yeah. I think you're absolutely correct. Just the way that CPI is calculated. And so again, going back into the context of how is this influencing the Federal Reserve, the bond market, this isn't like Matt and I have figured this out into secret.
Yeah.
Like it's well known. Federal Reserve has whole white papers on different, how they calculate it and the different, it's like, it's like this for a purpose. This is the way they want to look at it. So knowing that the shelter is the main driver right now, and we know that it's going to fall off regardless of like what shelter does next month.
Yeah, like mechanically it'll fall off.
Yeah, exactly. Is the idea of this 25 basis point hikes, which, borrowers are already kind of screaming for paying if you're on a floating rate loan right now. Mm-hmm. How much of it is, signaling? Because, they've got optionality. Or do they think, what's another 25 basis points? Let's just ram this thing home and let's do another one. Maybe we don't have to do two. But I mean, there's so much, we talk about this a lot, it's signaling and it's the psychology, which is really more powerful than even where they put the rates of indicating what they might do in the future. And once they've indicated what they might do in the future, the market takes that information and prices it in, does a lot of their work for them, and then they can decide, do we need to do that or not?
They keep it high, I think, and I've always said, like, keeping it high still hurts people.
Yeah, no one's talking about Fed funds is being reduced. It's just keep it at the 5.25 where it's
you don't get that psychological message if you keep it high versus like, oh, they raised it again.
I think we're not the hopeless abandonment point of where it's like there's no end in sight. We really have to make decisions. We have to cut. We have to make some hard decisions because we hear this from folks in the real estate space all the time. They're like, well, we just got to wait a little bit longer. We've got 6 months. We're good. We'll just wait this thing out. Rates are going to be lower. And for most of the evidence points that it will be. Mm-hmm. But that mentality also means that like, well, we're going to be reinvesting, and that's an inflationary mentality of like, we're still ready to go, ready to invest. But, does the Fed need to really kind of break the backs of that type of thought process and get people to a point, a breaking point, an inflection point, and where people are going to cry mercy. Yeah. Of where like we're done, and we're out of this business.
This was in the jobs reports that were released last week and late kind of last week and maybe this week.
Last week. Yeah. ADP, and then the actual jobs report. Yeah. Was really fascinating because ADP was like 400 some thousand, mm-hmm. which was like double the estimate. Yeah. For like huge shock. 10-year treasury, all the yields spiked, mm-hmm. which was not great. But then the real employment, not real, but the actual government report, I think from BLS came out, and it was like around 200,000 some jobs, which was a little bit below the estimates.
A little below. It seems like the amount of jobs creating is trending down, although they are creating jobs. Yeah. What I've also heard in some of the discussions is that I think it's called JOLTS. It's these job openings tracker. Mm-hmm. Yeah. These job openings are not not increasing as robustly, or maybe decreasing even, which is kind of like forward indicator that employment is not bad, but it's not growing as much as it was before. There is a cause and effect to having higher rates, I think.
Well, it's like, exactly. It's shocking that unemployment dropped, mm-hmm. Further dropped. Because I think participation, I think went up, and I was just looking for that, looking for the labor participation rate. Obviously it dropped down in the pandemic. Let me zoom in on this chart real quick if that's appropriate. It's not great, but it is trending upward. We're not mm-hmm. back to pre-pandemic levels. I don't know what this little flat line is, but I guess it's not great. It's not horrible. I think they want to see that get up there a little bit. But it's all signs, and we talk about this a lot, Matt, mm-hmm. of just the economy is like still really strong in a very weird, uncomfortable way. Mm-hmm. And I think that the folks in real estate are feeling it more so, where like the tech industry was feeling it last year. Yeah. And which again, tech in that type of investment is a leading indicator, and it's much more speculative, and real estate's a slow moving object. We talk about this all the time, Matt. It makes sense.
Well, and I think tech's still hurting a little bit. I'm reading articles about about guys that get fired. Like, oh, I'm looking for $600K a year. It's like,
oh, they all went over to Threads
for 200.
But it's like, all the guys that got fired from Twitter, or not all, but like they all got hired over Threads. Yeah. Like I haven't heard too many stories of like employees, people working in the tech industry are like hurting because they're still getting jobs,
non-tech,
or other companies, or they're working for an AI company, right now. But and then the broader tech sector, is still having problems outside of AI. AI is like, it's going up like a rocket ship in many cases, but it's but the seven big tech leaders, your Facebooks, Amazons, those are doing really well, and those have recovered and are really outperforming. So they've recovered, but now it's like real estate's turn, and just from a standpoint of we know volumes are down so much. So much of the industry is based on transactions, brokers, insurance agents, syndicators, a lot of their income is derived from transactions.
Oh yeah, good point.
And that's down, 70-80% this year, which means that folks in commercial real estate incomes are probably down 70-80% this year.
Yeah.
I saw a post on LinkedIn. I don't even know who it was. It was like, be thinking about someone, if you know someone working commercial real estate, check in on them, because like, they might be going through a hard time right now.
Oh, wow.
Yeah. And you don't think about it because everyone is, in the business world and in real estate, it's all, kind of not like super macho, but a little bit, super best, strongest mindset and like, going to get through no matter what, which is, you got to have a strong attitude to get through stuff. But doesn't mean that everything's okay.
Yeah.
And so, to everybody out there, because I know a lot of the folks listening to this podcast are working commercial real estate, not just investors, but they're operators, they're in the industry. Hope you're all right out there.
Yeah.
We're gonna get through this. It's a time to be smart. I also think it's time to, you might exploring, different, lines of business, different ways to go after it. It's also, if you hadn't planned, it's always good. You never know when music's gonna stop. And you should, if you hadn't had this mindset or planning prior to this point of planning for that rainy day, having that emergency fund, you should have, and maybe now's the time to think about it for the next time if you can get through this. There will be some people that just got into this industry or have been in this industry for a while, whether they're going to either decide to retire or move on to something different, because it's like there's no money to be made. Right now, it's not as attractive, and you can't support yourself. I mean, most brokers, work on commission.
Yeah, that's what hurts. There is so little movement at all. There's so little. Even if you're thinking about buying or selling, there's so many. Just as maybe people will stay with the job they have if it's not going great. People stay with a building that they have if it's not really great. And I think that there's something to be said about cutting your losses, as bad as it sounds. Or just not kind of clinging to something. And you were talking about like forward looking, looking forward for the rates and stuff. And rates will go down, but maybe even if rates go down quickly, it still might be worth it to figure out another solution rather than just doing the same thing.
Yeah.
Things are different now.
Maybe we've talked about this on the podcast recently. We've talked about it internally, but there's the book it came out probably early 2000s or so. Is like Who Moved My Cheese, and we've talked about it. And are the typical value add strategy, like, is it gonna? Yeah, of course it's gonna work again. Is it the typical ways that we were buying deals and business plans? They may not be working right now. We're really not finding much that pencils at all. So what if the cheese is moved? That opportunity no longer exists. What are you going to do?
Yeah. And it's always moving. It's always moving.
Well, what's the one constant is change,
Gosh. And farther in some of the other reports that came off is talking about, demand's increasing and maybe rent growth will follow, but the context of that is that operators are dealing with still increasing expenses, which I think is relevant in this inflation discussion. If we're talking about CPI, is it seems like the real hurt of expenses was felt in 2023. Yeah, the bulk of the number, if you're going by the numbers, the run up in inflation was maybe 2022. But man, this year I've been hearing a lot about expenses way more than last year, not just in the office, but in the newspaper.
Yeah, no, I have too. And a lot of it is just like at the rate and pace that like contracts and prices are updated. Sometimes I think, things are done on an annual basis. Yeah. And like, last year they didn't increase maybe. And so this year it's even like an even bigger increase. So like the sticker shock continues.
Yeah.
The big areas that people are seeing are, utilities have just been, incredibly rough. We were on CoStar yesterday, Matt, and we were looking at some notes on some properties that are in special servicing, because they're somewhat delinquent on their loans, and some of there's typically notes and some of them are from the borrower on why they are delinquent, and there's probably some other issues going on, but what is claimed is utility increases. It's a lot of these fixed expenses that they can't really do much about. So, utilities, property taxes, insurance.
Yep.
There's not a whole, there's a little bit maybe you can do to some of those. You can appeal your property taxes. Sometimes it works.
Mm-hmm.
Sometimes it doesn't. Depends on where you are. Utilities, you can, try to be more efficient. That can cost money to do that. Doesn't happen overnight. And if you can, you should. But kind of on the margins.
Yeah.
Not overnight. And then insurance, you can shop around, but it's not going to be like you're going to find something for a fraction, unless you're going to be underinsured. So then you're not even getting into payroll and, intern costs and everything else.
Yeah, like vendors and renegotiating. It
comes up and they're like, hey,
this year.
Yeah, it's been over. What if you're on a 2-year contract? You're 1 year, and hey, it's up. And maybe last year you were able to say like, hey, we need to keep it the same. And they're like, okay, well, it's been 2 years. We've had, 9% inflation last year.
Yeah.
Whatever they average for this year will be.
They have to pay their people and their supplies,
everybody.
Yeah.
And that's where this idea of, and the big question and why we're talking about CPI is, we haven't talked about, okay, see some deflationary pressures, right? Could be going down. But then there's all these other things that are going to keep popping up that are going to keep inflation a little bit sticky.
Yeah.
Like unemployment is still low. These prices are still increasing, and that continues to feed that feedback loop. It doesn't seem like we're in a complete wage price spiral, but wages are still, cranking up. Yeah. Prices are still moving.
You're talking about sticky inflation. We could talk about that Federal Reserve of New York article.
Let's talk about it. Let's go there and then let's get into student loans.
Yeah, because the question they ask is, where is inflation persistence coming from?
Where is it?
Well, I was thinking, used cars, maybe, semiconductors, eggs. You've heard it. Who can forget those fraught eggless weeks of February 2023?
Remind us of the dark days.
Is that the answer? Is eggs inflation? No, it's not those. It's rents. And, I'm sorry to apologize for...
It's all fault. It's our fault.
For, burying the lead a little bit. But it is rents. Viewers and listeners of the Gray Report all know full well that, and we've just said it, rent of primary residence is the most out-of-whack metric in the Consumer Price Index. And the Fed knows it, and it shows it. It basically says if you're looking at core inflation, housing, now that is the this bar graph. So you can see separated into different colors, different factors that are contributing either in the positive or the negative to the run-up in inflation and the moderation of inflation. Right now, we have housing. They lump housing together, but for all intents and purposes, this is rent. Rent is the one that's driving these housing prices right now, and it is contributing. If it were accurate, they have made this. They have made another metric called the multivariate core trend that kind of corrects for these housing delays. Basically, it means that housing flips from contributing like positive 0.65 to negative 0.1. So if we are really accurately calculating rent at this point and figuring it into our calculation of core CPI, then it would be negative 0.1. It would be much lower. A full swing of 0.65%. That's huge in the context of the entire inflation for just such a tiny chunk.
Yeah. That's what it would be if we were looking at CPI more in real time, or rent, rent growth relative to CPI.
And the real upshot to all this is that I think they have their multivariate core index has inflation in the negative. I'll have to look at the line graph, but basically, it's not fully in the negative, but it is definitely trending negative. Now, I think that was what that bar graph was saying. It's like, how much is each of these factors contributing to the trend?
Yeah.
But clearly falling off, and falling off maybe more powerfully than the kind of top line numbers. So
we're saying it's rents.
Yeah.
Now, well, but coming back, what about the more than a year or so? I mean, we know if rents are going to go down, so we know that like in a couple months, within a year, it should drop down.
Yeah.
When we talked about, wages, we talked about some of these contracts. What else? Because, it's interesting, you hear there's a lot of different opinions if it's going to be higher for longer, or we're going back to 2019. I think it's, probably somewhere in the middle, moderately higher, but I see the argument for like it's not going to be down to very low rates like very soon without a major downturn and recession, which I think is going to have to be caused by some black swan that we're not aware of right now. And if not, we're going to see a moderate inflation, but I don't see it. I mean, we're down to 3%.
Yeah.
So like that's not. I mean, there was discussions of where like 3% should be the inflation target.
Yeah. Well,
I mean, remember that debate?
Well, yeah, and I remember.
What's wrong with 3%?
It's still part of the discussion. It's higher for longer. Get used to it, kind of.
But it's higher. But it is higher 3%.
And if that,
but what I mean, just what's the base? What's the model? What are the inputs to get us now back to 5%? Because that's going to mean we're going to have a lot more inflationary pressures. What's that going to come from? We're not seeing the rent growth anymore.
Really good point. Because like short of, if we're talking core, that takes out gas and food, it's hard to see. There's always things, that swing.
Onshoring is big.
Yeah.
I mean, that is going to be inflationary, but that's going to be a low burn, over time, and probably going to be, good for, the economy, and it's going to be more isolated in different markets. It's going to be inflationary for like in markets like the Midwest, because it's going to be a lot more jobs coming in, a lot more economic activity, which is kind of fine. The Midwest is usually like a little bit below growth, so
Well, and we were just talking about this before, as is the global factors. If China is massively stimulating, if there's still inflation in Europe, there's still a lot of time.
Well, that's the thing. The trend sort of, if you look at China, whatever indicator that could be, I mean, but they're on the brink of deflation right now.
Oh, okay.
China, they're deflating. They're
really trying that hard.
China's stimulating.
Yeah.
They're printing money because there's so much deflation in their economy. And so on one hand, it's like there's enough global deflationary pressures, and China is again, it's not the United States, but it's one of the world's largest, first economic powerhouse.
Yeah,
they have if there's deflationary forces coming from that large part of the global economy, what does that tell you about the trend? And then when they're stimulating, again, one of the world's largest economic powers, if they're pumping stimulus into the economy, which is inflationary.
Good for us.
Yeah, so it's exactly. It means that can we really have a big crash and demand drop off so much when there's still so much stimulus going on?
Can you bring back that bar graph? Because it may help figure out what are these big factors. So if you look at it, the biggest factor that you can see on the side of the moderation is shelter in the core inflation, bringing inflation up. On the run up, the biggest factor for core inflation was the motor vehicles and parts. I don't know that much about motor vehicles. I knew that the computer chips were making cars harder to build. So that was, and I think also people realized during the pandemic, like, oh, cars are worth a lot. I do need that.
Well, but then the amount of debt that, consumers have on vehicles right now, and vehicles right now are like more unaffordable than it's like the single family home. The monthly payments for a car right now, if you get a new car, are crazy.
I keep putting off getting a new car. My car, as it shifts into second gear, maybe it's third, but I pat myself on the back every day I drive it. I'm making money.
Yeah. It's like ching. Yeah. Seriously. Yeah.
See that sound? It's the sound of money.
It really is right now. I mean, it's like, it's like you could want to buy a car right now, but it's just like buying a house. There's a lot of people want to buy a house, want to get a car, but it's not cheap.
Yeah.
It's not cheap. And
that's a good point. So one of these categories that we're seeing is it, whether both used cars and shelter, those are so hugely determined by interest rates. And I'm thinking about this whole thing, you're talking about what does Powell want to do? I think that if he keeps it higher or if he raises it, that just gives him it's like makes him feel tough. And I think that's such a big thing. Yeah. But I also think it gives him a bigger tool to lower it down. And we haven't seen that. And I remember talking about this like 6 months ago, if these problems are caused by interest rates, all they got to do is dial it back down. I haven't been thinking about that too much.
Well, and we don't even know that the problems are even caused, It goes to show how strong the economy is, how strong the demand is for housing. That that is incredibly sensitive to interest rates, and rates can be risen to where they have been. I mean, mortgages are 7%, 8%, which I know go back to the late 70s, early 80s, and that was normal. Late 70s and 80s, that was the aberration. That was not a normal time in history. Yeah, that we're not necessarily going back to, but. It's really expensive. It's all relative. Things are all relative. You can't say, well, because people say like, actually rates are still low compared to, when I remember when my parents, bought their house and, or when I bought my first house, and it's like, okay, that's your relevance.
Yes, the businesses are set up. The deals are set up for this environment, not for the 20 years ago environment.
Yeah, exactly. It's like, how far do we want to go back? Around the long-term average, if I'm remembering right, for like, general interest rates, like historically going back hundreds of years, if not 1,000 years, is like 5%. Yeah. So like we're not like too far off, from 5% right now. So like, rates aren't like abnormally high in that context. I would not call them low. I would call them higher than average over like the long historical context. Yeah. But very high relative to how the economy has adapted to a low rate environment over the last, decade.
And all this stuff, set up for, it's also, it's like more trusting or things that get, if interest rates are an expression of risk, and maybe back 100 years ago, things were maybe a little bit more risky.
Absolutely. Things were more, absolutely. Things were more risky.
I was getting a little out of my depth there, philosophically.
It's okay. Well, Matt, before we go on to talking about student loans, because this I think it's all in the same, topic what we're talking about. Talking about housing demand, this is all how affecting multifamily, whether from the borrowing side to, rental demand. But another thing that I think this is going to be resolved, but the potential, the Teamsters strike for the UPS workers. I don't know if you've been following the story. So there's been huge trade negotiations between UPS, represented by the Teamsters. It's the union shop, and UPS. They're going for obviously pay raises. They're at a deadlock. I think, the Teamsters and the employees basically walked away from the table after UPS made an offer. They're like, no, no thanks. They move around a lot of stuff. Yeah. Supply chains. Yeah. There's obviously other sources to get stuff moved around, but UPS moves around a lot of stuff. And again, I think it's short term. I don't think it's going to materially affect things, but when we're going by month, play by play, and every new data point moves things, that could be something that, would be like we didn't realize, weren't really keeping our eyes open for. And all of a sudden we could have a slowdown in, goods deliveries. That's not China related. It's just an internal, like a labor dispute.
I read somewhere that people get more amenable to the idea of unions when economic times are good. Or at least like things are going well, it's fine. That'll help me get a little bit more money.
When times are good?
When times are good.
Because they're saying that like, hey, things are good, I should be getting more.
Kind of.
And like my employer, like you've got the money.
This is the logic that I thought was. And then when times are bad, well, I got to get a job. I don't care about union. I just need a job.
Yeah.
There's a logic there, but I do think that was it the Biden administration got in the railroad strike? Things were that big, and they had to step in because they knew the implications of stopping moving things.
Yeah, and I think that's exactly what's going to happen in this case too. That if it even gets close to that, I think the government's going to step in.
Yeah,
and do something and say like, look, UPS, you need to. No, I don't think it's not the government's like job to do that, but that they see it as if it's an existential threat to inflation. And again, the federal government, they're paying. Think about the interest the federal government is paying right now.
I think it would hurt the economy more if the strike continues rather than. I think that whatever concessions they give is not going to really bump up the shipping that much. If the real pain is things aren't getting moved around.
Yeah, no, I don't think it's the shipping price isn't going to get bumped up, but people stop moving things around. Just the last thing, and then talk about student loans. Yep. Adding another thing, but the whole war in Ukraine. It's very inflationary in general. We're spending a lot of money. There's a lot of arms manufacturing. It's been disruptive. Now a lot of that's priced in and sort of normalized. But if that stops, which who knows? I think that most interests in the United States want the war to keep going indefinitely. We no longer have wars in the Middle East we can keep pumping whatever into. So we got to have some conflict. To keep eyes peeled somewhere else, and Lockheed Martin.
Keep all the government manufacturers factory running for sure.
Got to keep making stuff. Got to make that artillery ammo. We got to make some more Abrams.
One for me.
Why not? Make out it's anyway.
Yeah.
It's being driven by profit at this point.
Yeah.
And so I don't think it's going to end anytime soon because of that. But if it does, that would also be a turning off the faucet of some inflationary pressures.
Yeah,
which was basically the reason why they said initially that inflation is no longer transitory is because there we go. Is because this war in Ukraine. Yeah. Inflation. That's the problem. So that those are just those are the we're putting stuff on the board. Well, we don't know, what's the weighting, but it's what's going on.
Does seem though, general trend going down.
General trend is to deflation. Okay, let's talk about student loans. John Burns, Research and Consulting. You probably know, the Biden administration passed, basically an unconstitutional executive order for got to basically forgive a bunch of government student loans. Supreme Court said you can't do that. Not surprising.
It was a happy turn of events for student borrowers who love the idea of paying back. If you love paying back loans, then you were
there's not what's going on in 2024. There's not like a political event that's happening.
Yeah, they got plenty of time
in November
to do something else.
Can't get you got to get it to a certain demographic. Anyway, but so this is in an ideal world. Mm-hmm. Borrowers would have been, pocketing and escrowing that money because it's not for sure. Yep. I don't think any of that happened.
No, these are kids. Even 35.
I was going to say they're kids, but I mean, like a lot of them are. Yeah. I mean, I guess they're 30s.
Yeah, I'm one
adults.
Of them. Yeah. I'll tell you,
Matt, we're closer to 40 than 30. So
yeah.
I don't know. But I don't think.
No, but I do agree, and I was one of these borrowers, and I'm still on like this income based repayment plan, and so it wasn't that huge. I think that some borrowers it's going to hit them a lot, some a little. I think some borrowers have not availed themselves of all the payment plans and opportunities that are offered to them.
So. Tell me a little more about that, man. I mean, so like, you don't have to get like too deep into your situation, but what are the options?
Payment plan? You sign up. I think that the lenders make it hard.
Yeah,
they don't want you on it. They want you to pay as much as they can. But you go and you pay a percentage of your income, and they calculate, how your disposable income and how based on like tax filings, and it takes out that percent. And as far as I know, you keep paying that for 20 years, and then the loan will go off the books.
Just what you pay, like this is what I can pay.
Yeah. Okay. Hey,
and that's already available.
Yeah, it's already available. If you make $20,000 a year, you go on the income-based repayment plan. There's a good chance that you're not going to pay anything at all, depending on what your loan is and what your situation is. I think, that's that's a lot to say. That's giving short shrift to the people that are really paying a lot, because ultimately, when John Burns crunched the numbers, he's saying that the average loan payer is paying $400. Now, there's a Moody's article that I'm pairing this with that I think that people should also read. Their number's closer to $275 a month that they're paying, but still, that's a lot of money. Just to add every month, where's that money where would that have gone anyways? A huge chunk. And now this is what I was talking about, Spencer. It's like, how much did this drive inflation, student loans? How much did this drive rent growth? Because if rent is the kind of the biggest payment that people are making, and they suddenly have $400 more a month, well, they can get $400 more of an apartment.
Yeah, I don't think that, again, I don't think they were saving it. And so, did they, and it would have been a bad, they couldn't have, I'm trying to think, like those debts, like when they qualify, when they qualified, like that would still show up, I would assume, in their like income qualification, or.
Yeah, probably.
I don't know.
But I
don't think so.
But one really important data point here now, and I had to go elsewhere with this. Yeah. Was the Education Data Initiative has some data on the age of borrowers, like a lot of demographics on kind of how much what these borrowers are like, and 34% of the 18 to 29 age group has student loan debt. 22% of the 30 to 44 age group. 7 for 45 to 59, 1% for 16 over. So the younger demographics, those that are most and more likely to rent, are those with the most student loans, which really isn't a surprise. Yeah. The total, 43.6 million, have federal student debt. Now that bumps it up a little closer to, it's a little higher if you're including private loans, but essentially, the average federal student loan debt balance is $37,000. There's a lot of people. A lot of people in the right age groups to rent are being impacted. Now, what's interesting in this, and John Burns is housing largely, and it does lightly talk about potential impacts on the multifamily market, but really it's focused on the kind of inflationary and broader economic impacts.
Yeah, I just did some like really quick math. You can just like 43.6 million borrowers. So if I was on average, I took a $200 payment, and not the 400, just like 200, it's $8.7 billion a month in economic. So if they were spending that money,
so true,
not saving it, which the mass majority were just spending it, they're not saving it. It's between 8 and 16, depending on how you want to pick it, $8 to $16 billion of economic activity every single month, and now it's going to have to be going to pay down loans.
Yeah,
I don't know if paying down loans, I don't think that's really going to be generating any economic activity. It's not like the federal government is getting that and reinvesting it. I don't.
Yeah, and it's so hard. It gets like muddy and kind of diffuse if you're thinking about like the benefit of the paying loan. Someone's got to benefit.
I'm not arguing that they should be forgiven. Because again,
I am. I think forgive all loans all the time. Yeah. Let's have a jubilee.
Yeah. I mean, that would be the nice thing to do. And there's you can make an argument, but the argument is inflationary. So it's like you do this, and then like everyone's purchasing power goes down. And then again, the moral reasons to not do it is, Matt, you are a PhD, who has a job.
Yeah.
Why should your student loans be forgiven versus, this is like the narrative, or this is the talking point. Yeah. But if I went to a trade school to be a plumber or whatever, or electrician, and I took on a lot of debt to go to trade school, my loan's not forgiven.
Yeah.
I'm trying to work.
And what about the guy that already paid his loans off?
What if the guy who already paid his loan off, he was responsible? But one thing that, Matt, we continue to learn is that our economy consistently accommodates those who make the biggest mistakes and errors and mess up the most.
That's true. Where's the Federal Reserve guidelines for workouts for student loans?
Yeah, exactly. It's like you took on way too much debt. You over-levered on some office building. Well, the more risk you took on, the bigger break we're going to give you.
Yeah.
And it's absolute moral failing, and creates a moral hazard in a huge way of saying it's okay to take on debt and take risk because we're going to bail you out. Yeah. And the economy is not going to function. Markets aren't going to function if we have that type of system. Even though it seems nice to have a bunch of safety blankets are, I don't know, for all in harnesses, which is great.
I think that there's something, I'll just say lame about student loans and giving kids these loans without really, you don't really know. Even in grad school, it was a far off thing. It's not like a product or a car or think this is your education. It's always assumed that it is an inherent good, and you're not really equipped. And especially when I was going through grad school, go get more education.
Yeah. Who's more, who is preying more on American youth in society? Is it the payday lenders or is it Sally Mae?
Yeah.
I mean, really, if you look at the effect, is it the payday lenders who are, charging a stupid interest because, you're getting advance on your paycheck? Or is it the group that's sponsored and run by the federal government that is influencing kids to take on massive amounts of debt that they can't get out?
Can't get out of. You can't declare bankruptcy and get out of a student loan debt.
Yeah.
I'm sure that they'll pass laws that'll make sure that it's transferred to your next of kin.
Yeah.
If you die.
So it's unfortunate. It's unfortunate.
But I don't think that anyone was really it seemed so far-fetched when they even announced it. They're really forgetting people.
Well, I mean, Biden himself was like, they'll probably won't let us do it. I forget what he said, but he's like, it's most likely unconstitutional.
Yeah.
And they're like, correct.
To kind of go to this Moody's Analytics article, they do really put a very fine point on it, a little bit more specifically than the John Burns, and connect it to the housing market and to really, I think, to the multifamily market. And they said, and I just want to read this whole paragraph. In a recent study by Moody's Analytics chief economist Mark Zandi and his team, as many as 5 million student loan borrowers will need to resume making payments close to $275 per month on average, amounting to nearly 0.25% of GDP. Under the assumption that total household income does not change by the end of student loan moratorium and the percentage of total income needed to pay rent stays the same, the monthly reductions from resuming student loan payments will slash any financial buffers, forcing households to cut back on discretionary spending, face difficult household decisions such as trading down, or even having to share a unit with friends. And on average, a median income household spends about 30% renting. So for places where large rent disparities exist between Class A, Class B, and C, taking $275 out of that monthly budget may force families to trade down. So trading down, that's one. Getting roommates, maybe instead of getting an apartment by yourself, really maybe even staying put instead of deciding to move up. Maybe you had a bump in income, but because of that $275 or however much you're now paying, maybe it's $1,000. Now you can't move up because you're just limited. There are all these scenarios that could drive down apartment demand. I don't think that this is going to be offset, because the point of John Burns' article was this is going to maintain the renting population. This will exacerbate the barriers to owning a home. I don't think that is enough to counteract at least the temporary effect that's going to have of people getting all that money cut off.
Yeah, I think it's a long-term, short-term. Yeah. And again, it's so frustrating what, the administration did to these folks, in this 18 to 29, but that's the largest percentage, 18 to 29-year-olds. That's the voting block that they want to win over, that they want to have turnout at the polls. Yeah. And this was all about just getting that demographic group, excited to show up, in November of 2024.
I don't believe that.
You don't believe that? Well, I mean, it's fine. I'm sure they thought I was good, but they knew.
Oh, it's totally
that it probably wouldn't work. They admitted that, and they knew that it was going to get blocked. It was
part of his campaign promise, and so and all of the commentary from left and right are like, he kind of has to do this.
You have to do it. Well, but he could have done it through Congress.
Yeah.
And they controlled like both houses of Congress. So it was disingenuous. Like I believe that they wanted it to probably happen, but they knew it wouldn't happen the way that they did it. But what it did is it gave all these 18 to 29-year-olds who are incredibly irresponsible. They were like, I've got $200 to $400 extra a month in my pocket. I'm going to go either burn on whatever, or it all happened at the same time where rents were increasing an incredible amount.
Yeah.
And all of a sudden they were like, sure, okay, I think I can afford it because I think I've got an extra $200 to $400 because, the student debt sucks and, it's going to get canceled, I heard. I thought I'd already, they're not nuanced enough.
Yeah.
I don't want to make overgeneralizations. There's a lot of smart folks in Gen Z that say they're more nuanced than we are, Matt. They think that they're in the clear, and then all of a sudden they're going to be like, nope, sorry, you don't have that income. It's ours. And now they're in a position where they're paying rent where maybe they can't afford it.
Mm-hmm.
And then, whether it's collections issues, delinquency, bad credit, and eviction on their record, it set up a lot of their youth to fail.
Yeah.
That's pretty frustrating.
Yeah, they're going to have to make adjustments that they could have made. They could have been living in that B-class apartment.
It could have been fine if they're like, I know my budget, I have this obligation, and I need to work within my means. They had a false sense of what their liabilities were. They thought a liability had been taken off their books.
Yeah. And I, going back to multifamily, I'm still thinking, so we had this population where they were very amenable to the consistently raising rents. There was no hard ceiling. There was no kind of negative feedback when rents were raised. And now, we may see the opposite effect. And I wonder, if they're saving money or not having to spend money, that doesn't have as much of a impact psychologically as suddenly having to spend money. You know what I mean? It's not like they gave you $400 a month.
Yeah.
They just didn't take it. Yeah. And now that they are starting to take it, you're going to notice that. I think, and that may affect decisions a little bit more, but that's just
it reminded me of the stimulus checks a little bit. I don't know what it's not a good direct correlation.
But stimulus, exactly. Like that problem, that was a bigger psychological, and that's what people were talking about. Mm-hmm. They weren't necessarily really talking too much, but I mean, they were, but it wasn't that heavy in mental image as free money.
Yeah, I agree. Matt, Fannie Mae, bit of peace, consumer confidence. Anything else on this? I don't want to.
No, that's a good pin on for sure.
Fannie Mae consumer confidence in housing may have plateaued. It's been amazing how much confidence there has been. The demand in housing, maybe it has plateaued according to Fannie Mae, which we're watching you, Fannie Mae.
Yeah. So this is I just wanted to outline the trajectory, the kind of larger trajectory. We're definitely in still a seller's market for sure. But if you look at, they have a nice little graph here, and they.
A frustrating seller's market. Like it's not supposed to be a seller's market.
Totally not. But the way that so the plateau they're talking about is not like a plateau of happiness. It's definitely like a valley, more like a valley of a plateau of sadness. Now, if we're looking at this,
it is valleyed. It is not plateaued.
Yeah, that's a good point. Yeah. Why did they say plateau? Plateau.
Well, the bad time. Yeah.
Well, anyways,
what are they?
What I was struck by looking at this chart is that since at least 2012, and probably longer than that, consistently more people thought that it was a good time to buy a home rather than a bad time to buy a home. But in April of 2021, these lines crossed. From then till now, people think that it's a good time to sell. People think that it is a bad time to buy a house. Now, the numbers for selling are about equal. If they think it's or it gets messy. If you measure good time to buy against bad time to buy, that's a lot. You get 100%. But there are plenty of people that think it's a bad time to sell at the same time they think it's a bad time to buy.
That makes sense.
Yeah, it would totally make sense because then, you got to go buy it. But anyways,
we got to buy it.
These crisscross. So the general optimism about about buying a home, it became it turned into the negative essentially.
Yeah, but people are still buying homes.
And that is a good point. And that's where you get into the idea like relative. It's like relative to what. I wonder if this is a function of of low market volume. If so many people think it's a bad time to buy, and
people are listing their house. The golden handcuffs. Everyone's got a mortgage rate below 4%. So there's a lot of people selling right now.
Yeah.
But there are a handful of people that still really want to buy, and then someone who needs to sell. And there's just there's enough buyers and sellers. You can still have price stability with low volatility, and low transactions. I mean, and again, that's not too dissimilar. It's a little different, but it's not too dissimilar. What's going on in the multifamily space?
Yeah.
Is that still, Matt. Mm-hmm. The prices that we're seeing on some assets, not all, we're seeing some deviations and different niches here and there. And man, it's competitive in Indianapolis still. But it doesn't make the reality that some of these sellers and brokers, the planet that they're living on, I am not familiar with it, where it is and what basis. And I don't think we don't know what the price should be. We know what we think is like a reasonable price to pay for it.
Yeah.
Based on like just doing it and having investors and doing a lot of deals and watching the market constantly.
Yeah.
And like we're so far off. Like on most deals, there's a couple deals that were close.
Yeah.
But they're the big ones.
Oh, interesting.
What we're seeing, don't tell anybody this. We're in our typical like range of, I don't know, call it 15 on the low end to $60 million.
Yeah.
Still, like there's enough buyers in that range, whether it be 1031, somebody just aggressive, whatever. Like there's still enough buyers that are like bidding it up to where it's like,
kind of like a medium size.
Yeah, medium sized middle market, I guess.
Yeah.
But it's on the bigger deals, the institutional deals. Now I'm talking 75 over $100 million. Not as much competition. Even though there's a lot of institutional money that will need to get deployed at some point, a lot of those big players are pencils down right now. They're not transacting, so it's in that higher price point where I think the most opportunity we are seeing is in deals that are 90 million and above.
Yeah, that's really interesting.
Yeah,
because those wheels, maybe it's easier for smaller organizations to.
Yeah, there's a lot of syndicators out there just run around trying to make it work. And, a lot of those guys are like, I'm not going to raise $30-40 million right now.
Yeah.
We don't mind going big game hunting.
Yeah. Yeah. Heck yeah.
I mean, I don't, it's because the deals make sense.
Yeah.
And the big deals, we've done a couple big deals, and there's a lot, like talk about economies of scale, why multifamily is great. The bigger the deal, it can get easier in a lot of ways. Now, if you mess up in a really, really big way.
What I am curious about, and now aside from like the numerical, this kind of difference between the middle market and institutional, maybe institutionals getting a little bit better prices, is on a deal-to-deal basis. And I get broker will never tell me this, but are they seeing, oh man, the buyers just aren't really biting? What's that trend? Has it been easy sailing? I'll ask for 50, they're giving me 50. I'll ask for 60, they're giving me 60. Or are they like, oh, now they're coming in 1 million under. Now they're coming in a couple more percentage points under. And like that would be really interesting to know, is how many bids were under a little bit, and by what percentage.
I can tell you what I've seen in my experience recently, and it's mostly focused in the Midwest and Indianapolis, so it's not a national perspective. It's relatively local, but often see some trends. Anyway, what we're seeing is that there's not a lot of buyers close to where, the whisper price.
Yeah.
No one's really getting to the whisper price.
Okay.
But we're seeing one or two buyers. There are consistently 1 to 2 buyers that'll be in an offering. First off, there's a fraction of potential buyers. It went from 20 to now that's like 5.
Okay, so that's a big point already.
Maybe some more on a really competitive deal.
Wow.
It's a fraction of people who are making an offer. You'll get 1 or maybe 2 that are close, and then 10 to 15 to 20% below that is everyone else. And the ones that are close are either like 1031 exchange money, like they have to place a deal and they're going to save a lot on taxes. And so they're like, guys, let's just do it. Let's pay up. Sometimes it's a basis play. We get guys coming from New York, California, coming to the Midwest, and they see a price per unit that seems low. They don't realize it's in like the worst part of town, and they buy it. So that happens too. But the amount of 1031 buyers, the people who are just paying that top whisper price, are getting fewer and fewer and fewer. Now, brokers are like, they're trying to hold the line. They're like, nope, you're way off on your pricing. You're way off on your pricing. But then we're like, are there any offers at that price? And they're like, no. Yeah. But then all of a sudden, occasionally, especially on an attractive deal, someone does come in and pays a stupid price because they're, they were searching the country.
Well, it's almost like, it's almost like you counting the wins and not counting the point spread. Like, it seems like, and that's what I hope you only see the winning bid, but if the point spread is suddenly the margins are starting to get a little close, then we could, then hopefully that is some kind of an indicator that the market's getting softer, or at least shifting to the buyer. But I think that the biggest thing you just said is like the fact that there are less people in there. That's got to be a big signal.
Yeah.
And as much as the broker's like, no, give them more money. I bet they're going to the seller and saying like, would you consider lowering the price? I don't know how what communication, this is a good question. How would the broker go back to the seller in that situation? Are they like, oh, sure, you can get $1 million.
I think it's the last thing that like a broker wants to do. Is just come back to a seller, because they're basically saying like they're having to admit that the price that they told the seller that they thought they could get, they can't get. Because basically you're hiring a broker to go out and get a price.
Okay, got it.
Or you're going to have to sell it. And you ask the broker before you get into it, like, well, what do you think you can sell it for? Mm-hmm. And there's typically a bidding process. Not everyone does this, but like you go to several brokers and you say, I want you to bid on what you think you can sell this for and tell me how you're going to do it. Huh. And, some put a whole package, or sometimes a presentation, sometimes it's an email of, okay, we did our analysis and we believe that we can sell it for this. And, we think we know who we're going to sell it to or whatever. And so you've often won that deal. A broker, you're just getting the listing that's the big thing. Mm-hmm. So you've won that deal saying, I can get you $20 million.
Yeah.
And then, but the offers are only coming in at 15 or 13. Yeah, we're way below. In what's I think it is really frustrating to these sellers is sometimes the prices are coming back at what they paid for it.
Yep.
Oftentimes, a little bit below, but like oftentimes it's like the price that we would need. I don't know how many deals we've seen like this. The price that we would need for it to work is the price that they paid.
Okay.
And it is what it is. We're saying, we get it. If that doesn't work for you, and it may not, then like we're not the buyer for you. But like it's the math and accounting for the risk in the market. Now, if someone wants to overpay and to not take into account, they can go ahead and do that. Yeah. But it's not a happy. If you overpaid by 10 or 15%, and then the market is down 10 or 15%, well, yeah, your equity is maybe wiped out.
Yeah.
If you have to transact today, if you finance where you can hold on for another 5 years, you're probably going to be just fine.
Well, that's what I was wondering too. Even just in the micro of a single deal, what's the cost of them saying, okay, I listed it at 20, people are only coming in at 18, I want to walk away. They're probably wasting a little bit of money because they've paid for some stuff to get this deal done. But I don't know.
You mean the seller?
Yeah, the seller.
Yeah, a little bit. I mean, the brokers pay it only when they sell it.
Okay.
Maybe they've fixed the property up a little bit, which they probably should have done to do anyway. Yeah. So they're just frustrated because they can't. Some people are like, oh, I can get X, great. They see the money in their head, and then it's like, no, we have to hold on to this for 5 years or hand it back. Hasn't happened too much yet. Okay, apartment demand rebounds. Real page, Matt, and then we're going to have to run, unfortunately.
And this is just a really quick note I wanted to make here. This and there's another Real Page article that was posted in the past week that talked about demand's going up, rent is cooling. And that's not going to sound great to apartment operators that are still dealing with rising expenses, but I think demand's a little bit of a leading indicator, and it shows here how in Q2, Q3, Q4, 2022, it had the weakest demand since 2009. And in 2023, now we're finally getting solid, not spectacular demand, but I think that's correlated with rent growth. And so it's a positive sign. And the fact that it is increasing from Q1 to Q2 is a really good sign. Not as strong as it used to be, but it really does support, I think, the idea that we're kind of getting back to normal as best we can.
And sometimes absorption is also driven by, because there's a lot of supply that's been coming online. And when there's new supply coming online, people start, renting up those apartments. It can kind of be a self-fulfilling prophecy in a way. But, it's if we weren't seeing relatively strong absorption, it'd be not good because of all of the new supply that's coming online across the country, no matter what market. I mean, even markets in the Midwest that have a fraction relative to the Sun Belt, still more than the average, by quite a bit. I think, like Indy, we supplied 2,500 units, in 22 or so. Now we're doing 4,000 some this year. So it's almost double in supply.
Yeah.
But it's not the 10,000 that are in some other markets.
Yeah.
20,000.
It did seem like the rules apply starting 2023 and maybe even, Q2 2022, but the rules are applying now. Now, when you're getting this supply, it's actually going to have an impact. And that's what we're seeing kind of across the country, because everything got huge supply after the rent boom of 2021. And it just seemed like gravity exists again.
Yeah, exactly. And it's solid. It's like kind of like, yeah, this is what we should expect.
Yeah.
And if it was just a huge spike in absorption, that'd be a little troublesome from the inflation. I mean, it might be good for us apartment operators, but the inflation story would be not as good.
Yeah. And just finally, they do, rent growth is a little lower than it was. And it may not be in this. It's probably in the other article, so we don't have to talk about it. But rent growth was month over month a little lower, but it is increasing. Oh no, they do have it. All right, great. So you can see the green bar here is the 2023 month over month change in apartment asking rents. Now it's all lower. It's all lower than 2022. It's all lower than the pre-COVID average, but it is increasing. April's, from March to April, May, and June, the month over month change in U.S. apartment asking rents is increasing to the point where it's
still a negative increase according to RealPage, right? I mean, it's still negative.
No, well, it could be negative year over year. I'm not sure, but no, these are all positive increases for the it's going no.
It's
true.
Yeah.
But it's just hard to look at that and compare it to 2020. And what I also want to know here, and this is just a very quick teaser for a report that we're working on. We are coming off the wake of the biggest change in apartment rents in recorded history. Now, the recorded history is maybe 1940s, but still, this is the biggest change in apartment rents.
Multifamily multifamily, as we know, didn't really exist like really much before then. So makes sense. Well, people have been renting out forever, but
I'm just since we started measuring apartment rents, and I think this is really meaningful, because there's been lots of times where it's dipped up or dipped down. Really, more times it's crashed down. All of the runners up for biggest change in apartment rents were when it went down. Now it went up. To think that there's not going to be some kind of a reversion to the mean, it would be foolish. The normal looks bad when you're comparing it to great, incredible. Yeah. But also, it also tends to go down a little bit and then go back up. There's a little bit of an equal and opposite reaction, and we're heading towards normal. And I don't think that it is that we are going down. I think that the trajectory is closing in on the historical average, rather than heading towards something that means that there's a structural problem.
You can slide at the end of the tunnel, all this.
Yes. Or at least, no, maybe not light. It could be a normal day. Could be partly cloudy. Could be whatever.
We're out of the tunnel.
We're out of the tunnel. And that's good.
That's even better.
Yeah.
Matt, this is great insights, great collection of reports. Make sure you're signed up to the Gray Report newsletter. You can hop on graycapitalllc.com/newsletter. That's going to keep you up to date twice a week with all the latest, research reports related to multifamily, commercial real estate, housing, and the economy. But Matt mentioned a recent report that we just published a couple weeks ago on upcoming loan maturities and potential distress in the multifamily market.
Oh, yeah.
It has been widely read, has been covered by a handful of outlets, BizNow, The Real Deal, CRE newsletter. It's been viewed, I think, by like millions of times, millions of impressions at least. Check it out for yourself, graycapitalllc.com/report. Got another report that Matt mentioned is going to be coming out early August, just before the next release of the CPI, all about just digging into like all these rent trackers, what is the actual rent growth right now? And as Matt says, taking kind of a 538 approach to it.
That's right.
So stay tuned. Make sure you're subscribed. Leave a comment, because probably next week we're going to go over comments and read them live. So give us your comment now. Thank you, everyone, for watching the Gray Report. We'll catch you next week.